since this is the first year of the note, we would have to take the 500,000 and we would have to multiply that times the interest rate they told me to be what, 10%? Okay, so since that's the carrying amount of that note that first year, 0.01 is going to be $50,000, and that's the interest for the first part of the year. So we would go ahead and do what? Debit the discount on note payable, 50,000, credit the interest revenue at 12/31, I think it was 2018 was the first year of this note in this example. Okay, now I'm pretty sure the next question, I seem to remember that I put in there, then asked the effective interest, the cash collection would be recorded as. And so what we're going to do is we're going to take this 500,000, which was the carrying amount of the note when we first signed it, the 500, the total note receivable of 605,000 minus the discount, which was the 105,000. 605,000 minus 100,000 gave us the 500,000 minus the 105,000. 605 would be the note receivable. Less what? Less the discount. The discount was 105,000, so the carrying value of the note was 500,000, right? And we multiplied that times the 10%. That's how they got the 50,000. So we debited the discount for 50,000. So that now put us at 605,000, the note receivable. And then we have to take the 105,000 and subtract what, 50,000? That leaves us 55,000 as the discount on that note. So for year 2, the carrying amount of the note is 605 minus 55,000. What are we getting there? 605 minus 55. 605, 550. Okay. 550,000. 550,000 times what? 10% for the second year means that our interest expense for year 2 is what? Our interest revenue, I should say, for year 2 is 55,000. Interest expense to the borrower. Okay, interest expense, interest revenue to us is 55. So when we get to 2019 now, when we actually go ahead and collect the cash, we will do what? Journal entry A here, which is debit the cash for the 605,000. We will debit the discount on the note receivable because we're getting rid of that, right? Credit the note receivable and take the interest revenue for year 2, which is the 55,000. So choice A. Right? We debit the remaining discount. We had 105,000 in the discount, didn't we? When we first got the note, we debited it for what? 50. Well, first year we debited for 50,000, right? Second year we debited for 55,000 to clear it out. It's 0 now, right? Then what? We debit the cash for 605. Obviously, we credit the note for 605,000, and we have the interest revenue is the 55,000. I showed you how to calculate that, right? Which is the carrying value of the note for year 2 times the 10%. Yes, sir.
So in this case, I know it's not the complete journal entry, but
Whoa. What's not the complete journal entry?
sorry, I was saying B, but I was saying B is not the complete journal
Oh,
entry, but it does reflect specifically just the cash collection part.
yeah. Yeah, I mean, if we had a question like this on the exam, I might give you the points back for B because that's confusing. when people write these test banks, they know the right answer, and then they start playing jazz with what could potentially be the wrong answers. Yeah, but this is the complete journal entry. Yeah, B is not. Um, so again, just to go through that whole thing, because I think it's worth it to, although I'm desperately trying to get to the next chapter, but I think it's worth it to look at this whole set of information again, because I'm still leaning towards your free response question being something like this, where you have to amortize something like this, and I won't give you the choices. You'll just have to do it free response. So it's probably helpful to, upon recording the note, they debited no receivable, they credited the discount, they credited the sales revenue, right? Okay, now the discount is what I'm trying to show you over here, got credited for 105, right? And then the carrying value of the note, pretty obviously, was 605 minus the 105, gave me the 500,000. 500,000 times the 0.10 gave me 50,000 interest for year one, right? Okay, so at the end of, this is what they did when they recorded the note, okay, choice C. Then at the end of year one in this scenario, which I guess was 2018, they went ahead and they took the interest revenue for year one by choice D, debiting the discount of the note, crediting the interest revenue, right? Based on the carrying value of that note, 500,000, the 50,000. So when they debited the discount came down to, what did we say, 55,000? Balance. Now the balance is 55,000. So when we look at the note, 605,000 minus 55,000 meant that the carrying value of the note for year two, tell me again, guys, was, 550,000? Okay, 550,000 times the 0.10 was the interest expense, interest revenue for year two, 55,000. Okay, and so that's why when we went in year two, we went ahead and credited the discount for 55,000, took the, debited the discount 55,000, took the interest revenue for year two, as 55,000. That zeroed out the discount. Okay, so that's all that they were doing at the end, was zeroing out the discount by debiting the discount for 55,000, debiting the cash for 605,000, which they're going to get back on the face, crediting the note, crediting the interest revenue for year two, right? Okay? Okay, so make sure you're comfortable with questions like that, because I'm thinking that I'm going to go ahead and give you something like this question, but then I'm going to make you kind of do free of hand without the choices the rest of what happened in that last question. Okay, so here they ask for the entry at the beginning of the note, which is simply to debit the note receivable and credit the discount for the discount portion of the note, which they got implied discount rate in the note is 10%. So we're going to have what? We're going to have this interest of the discount is $5,000. Where'd we get the discount from? Oh, okay. Thank you. It's 6 month note. I was trying to figure out what 10% gave me 5,000. 6 month, a 6 month note, right? Okay, so it's what? It's 100,000 times a 10% times 1/2 is the interest. Okay, so they set that up as a discount, and then the sales revenue is the difference. Now, I could ask you, even though we didn't talk about it in the slides, so this is an in-quiz teaching moment right here. The way you calculate effective interest is to take the amount of interest divided by what you actually got to borrow. At the end of the day, you only borrowed what? $95,000, because you're going to have to pay $5,000 interest on this, right? Okay, so you borrowed 5,000, so the effective interest, I mean 95,000, so the effective interest is the 95,000 divided by the 5,000. Okay, but what I could do with this question is ask you, I might make it a 2-year note and then ask you to calculate the rest of these things that we saw in this previous question without any choices there. Your free response is going to be something like that, I'm telling you right now. So you really want to be comfortable with this question, but also those other 3 that we worked before this. You want to be absolutely comfortable with that. You should be able to work that without seeing the choices. And I'll give you something like that in the practice midterm. Question?
Why is it multiplied by 2?
That's to annualize it. So it's thank you for asking that. When you call out effective interest, you call them out for an annualized rate. So since our interest rate was 95,000 divided by 5,000 for 6 months, to annualize that, you multiply it by 2. Okay? Can we get into inventory? Okay, I think the other question's like the same exact thing, and I want us to be a little more, get a chance to start to save, right? File, save as, browse, quizzes, chapter 7, quiz markup. Okay, and I'll put that up under chapter 7. Okay, guys, let's get to the slides, which are on Canvas for chapter 7. I mean 8 and 9, excuse me. 8, 9. Okay, so what I did, when you look at chapter, in case you're saying, oh, well, geez, we're just going to gloss over chapter 9, all they did in chapter 9 was add in some lesser used inventory methods, retail, dollar value LIFO, gross profit method. Okay, these are inventory methods that don't get used by companies as frequently, but we don't want to ignore them in here. So all I did was I pulled those inventory methods in with the discussion of some of your more basic inventory methods, and we're going to talk about specific identification. We're going to talk about FIFO. We're going to talk about LIFO. We're going to talk about weighted average, which are more commonly used inventory methods. So we'll talk about those. And but backing up a little bit, when you look at inventory, what FASB defines for us are maybe 4 or 5 different things. Okay, one is they want to see if we know what items specifically should be included in inventory. So we're going to review how we would handle something that was purchased under free on board destination, free on board shipping point, etc. Okay. Then they're going to want to see, once we know what specific items to include in inventory, they're going to want to see, do we know what cost to gather in our inventory? And the answer is any cost that we incur to acquire the inventory asset is part of the cost of the inventory. So that includes, obviously, the invoice price, but it would also include things like what? If we paid the freight to get that inventory, it would include freight in, right? Okay. Once we get the costs that are included in the inventory, then they're going to want to see, do we know how to value our inventory under the various cost flow assumptions that I just rolled off. Now we'll have specific identification that we'll talk about, but we'll see how to value the inventory under FIFO, LIFO, weighted average, etc. Okay. Once we have figured out the cost flow assumptions, though, we're going to have to understand something about carrying our inventory at the lower of cost or market, or the lower of cost or net realizable value. So we're going to have to understand that. We're going to learn that under U.S. GAAP, they decide for us to use either of those methods depending on what cost flow assumption we're using. for our inventory. So we'll see for LIFO, they're going to make us use the lower of cost or market. For the others, they're going to allow us to use the lower of cost or net realizable value. Okay, so we'll have to understand that. Finally, we're going to have to, and I say 4 or 5 things, because we're going to have to understand the difference between the perpetual method of keeping track of inventory and periodic. Most companies these days would use perpetual, but we can't ignore periodic because it's still out there. And I don't know, something stupid like the CPA exam or something stupid like that might ask you about the periodic method, so we just can't ignore it. Okay, so those are the 4 or 5 things that we're really looking at as we go through. And then, as I said, chapter 9 then starts getting some more boutique inventory methods that we'll just sort of tack on to the end of chapter 8. Okay, all right, so let's go ahead and find my clicker. Okay, let's see what we got here. Okay, so let's just take a look at the types of inventory in this class, guys. We are going to focus on our retail entities. In other words, we're doing the inventory accounting for Nordstrom. The inventory is already produced, and Nordstrom is going to be selling you a pair of shoes or something that they bought from a manufacturer, right? We will not worry as much in this class anyway about inventory for manufacturers. You can get that pretty much in Business 122A, where we start talking about the accounting for manufacturers. Okay, we're not doing that in this class. Okay, so you have to account for your raw materials, your work in progress, and how you matriculate through those different accounts to take your overhead, apply it, include that, etc., and end up with your finished goods inventory. Okay, we're just assuming that everything we buy is finished in this class, retail. Okay, but you can see that if you were looking at the financial reports of a merchandising or retail entity, we just call it inventory, whereas we might call out whether it's finished goods, whether it's raw materials, etc., in a manufacturer like Sherwin-Williams, I guess. Are they still in business? Sherwin-Williams, are they? Okay. Okay. All right, good. Now you come over and we take a look now of remember we were going to talk about what specific items to include in inventory. Okay. So we talk about items in transit. Now when you look at items in transit, we have our free onboard shipping point versus free onboard destination. Free onboard shipping point means title passes to the seller when the goods are actually what? Delivered. Okay, so when the goods are not delivered to the purchaser, but when they're acquired, when they're picked up by the purchaser, that's when they get included in the purchaser's ending inventory, free onboard shipping point. Okay, so let's just go ahead and put down a couple things just to make sure we're clear. So ending inventory